Oh, we're live. Nice. Good afternoon, everybody. Thank you so much for joining us again today. I'm your host, Jason Brand. I'm the Director of Outreach and Partner Development here at Supply Chain Solutions, and welcome back to the show. So today's episode, it's called Trade Policy at a Crossroads, and that title really couldn't be more spot on. We got a fact-filled one for you today, so make sure you sit back, relax, and let's dive right in. So as of last week, Thursday, President Donald Trump, his new tariff regime, has officially gone into effect. This is following several months of erratic signals from the administration. That's including threats, that's including walkbacks, that's including last-minute reversals. But the final directive was officially signed, and the U.S. Customs and Border Protection is now authorized to begin collecting the new levies. Now, here are the numbers. So the average U.S. tariff rate has jumped to 15.2%. That's a pretty dramatic increase from the 2.3% it was last year. And it actually marks the highest tariff level we've seen since the World War II era. And that is according to a couple estimations that were made by the Bloomberg Economics Group. So some of America's key trading partners, including the European Union, Japan, and South Korea, they've all accepted a blanket 15% tariff rate on their exports. That includes critical categories like automobiles, which would have otherwise faced tariffs as high as 25%. Other nations did not negotiate terms, and they were assigned rates unilaterally. Those rates started at 10%, but in some cases, they went substantially higher. And then in some situations, some companies were, some companies were not successful in securing relief. Switzerland is a great example of that. They attempted a last-minute push, but ultimately they walked away with a 39% duty still in place. In another notable move, Trump doubled the tariffs on Indian goods to 50%. That was a punishment for New Delhi continuing to import that oil from Russia. And those increases are going to take effect now roughly 2 weeks from today. So separate negotiations are ongoing with three of the U.S.'s top trading partners, Mexico, Canada, and China, and they're not included in that current round of tariffs. The administration has also announced upcoming tariffs, which are going to be targeting strategic industries such as pharmaceuticals and semiconductors, with one proposal that's under review for a 100% tariff on foreign-made microchips and possible exemptions for companies that invest in U.S.-based production. Now, the broader impact of these tariffs is still remaining to be a point of contention. President Trump maintains that these measures will reduce the trade deficit and will bring manufacturing back to U.S. soil. Now, on the other hand, economists and critics are warning that the result could be an increase in inflation, obviously supply chain disruptions, and also potential shortages of consumer goods. Now, to be clear, and to be extremely clear, none of those worst case scenarios have really materialized today. However, there are a few indications that could be suggesting we could have a troublesome end to the year. Now, the first piece, which I'm sure we've all heard of now, is that July jobs report, which revealed the most significant downward revision in employment growth since the COVID-19 pandemic. U.S. economic growth slowed for the first half of the year. Consumer spending was weakening, and businesses began adjusting operations in response to trade policy uncertainty. Now, unemployment remains low, and consumer prices have not surged, but the key thing here is they have not surged, at least yet. And that's largely because many companies have absorbed the increased import costs themselves, but that policy may not last. Wendy Cutler, the vice president of Asia Society Policy of the Asia Society Policy Institute and a former U.S. trade negotiator, she noted that many companies had built up inventories prior to the tariffs taking effect. Once those reserves are depleted, though, she's arguing that price increases are almost inevitable, because businesses are unlikely to continue operating with thin margins indefinitely. So since the first announcement back in April, the tariff program has created widespread volatility. We've talked about this week over week across global markets, and we've kind of talked about some of the effects of that. Now, uncertainty over the structure and the timing of the tariffs that were levied, that has really been the underlying fact that's, triggered these waves of high stakes negotiations with U.S. allies and also rivals. Many of the countries have now accepted the tariffs as kind of a long-term shift and have responded with substantial U.S. investment pledges to mitigate the effects and retain access to the American market. But there are a few key details that still remain unresolved. So, for example, The 15% auto tariff discounts that were promised to the EU, Japan, and South Korea, they have not been formally codified yet. And until they are, exporters from those regions remain subject to the full 25%. Likewise, the exact structure of the foreign investment pledges and commitments to expand U.S. market access still also remains undisclosed. So these could be pretty critical in determining whether these deficits will actually shrink. Meanwhile, financial analysts are urging caution. So last week, Monday, we had Morgan Stanley, Deutsche Bank, Evercore, ISI, all of them issued warnings to their clients about the anticipated near-term decline of the S&P 500 index. Now, those concerns, they stem from kind of the same mix of things: worsening inflation, also slowing job growth, and that weakening consumer activity. Now, the political backdrop, it's also pretty relevant. The cost of living issues were a major theme in last year's election cycle, and the current polling reflects growing dissatisfaction with Trump's approach to trade. A pretty surprising poll actually emerged. This came from Fox News, and that poll showed that 62% of voters disapproved of how he's handled tariffs, 58% are opposing his broader tax and spending policies, and 55% are unhappy with his overall economic management. Now, on the legal front, challenges are also emerging. Trump has been using emergency powers to impose country-based tariffs, a strategy that is facing court challenges. Now, his team is pivoting to more stable legal footing by imposing tariffs based on specific industries, such as automotives and metal. According to Tim Meyer, a law professor at Duke University, the administration is attempting to frame this as kind of the end of the tariff cycle and a start to a new era of certainty. Now, Meyer also warned that the administration's ability to fully implement these policies is in grave legal footing. We're having some issues there, let's put it that way. But despite these headwinds, Trump is remaining pretty confident in his approach. He has dismissed all the negative economic indicators, even going so far as to fire the head of the statistics agency after the release of the unfavorable jobs data. Now, Trump has pointed to surging tariff revenues as evidence of success, with customs duties reaching a record $113 billion over the past 9 months. And the administration has also floated the idea that using some of these funds, they could do direct rebates to American citizens. But there are a lot of questions that remain. And in my personal opinion, they are a little bit short-sighted, but they are worth discussing. So the central promise of the administration was to reshore manufacturing. And Trump and his advisors are arguing that tariffs will drive a resurgence in U.S. factory jobs. But and this is kind of where I don't fully agree. But economists in general are kind of pointing this contradiction, saying that if the tariffs succeed in cutting imports, tariff revenues should fall. If revenue is rising, that suggests U.S. consumers are still buying foreign goods at higher prices. And, Brad Jensen, a professor at Georgetown University, McDough School of Business, summarized it in this way: both cannot be true. If domestic manufacturing rises, we don't have tariff revenue. And, while I believe that to be true, and obviously the $113 billion over the past 9 months is a historic high, I don't think the goal is having that tariff revenue for the long term. And I think the administration has made that relatively clear. But this is something we run into regularly when it comes to supply chain data. A lot of inferences are made off of short periods. But it still does highlight a dilemma that tariffs can't be really used as a long-term solution to the deficit. Now, that's really where things stand right now. We do have this new aggressive list of tariffs that a lot of our customers are having to kind of navigate. There are a lot of opportunities for our customers to, if they really understand where they're sourcing everything from and which areas are the highest risk, to kind of make some alterations. We are entering, and I do believe that this rebranding of the tariffs into a new era of certainty, this is a ripe time to kind of assess where you are getting your goods and really look into places that might be the best opportunity for you now. And our team is able to help with all of that. Now, we're going to continue monitoring the impacts across all these sectors. Particularly, we're going to be looking at manufacturing, retail, technology, and of course, global logistics. But this is a new trade landscape. And if this really is the next era, this is something that I think we all need to get caught up on and really understand where are the opportunities now, given these big changes. As I mentioned, we still have some of the major agreements coming down the line. And given the industry-specific targets, that can be a little challenging, particularly if your industry plays in that area. But anyway, I appreciate everybody for joining us this week. Thank you so much. And make sure you catch us next week, Thursday at 1 p.m. live.